Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Joe Cornwall of Puma Investments to talk about the Puma AIM Inheritance Tax Service. Joe, welcome to the studio. Firstly, tell me what the Puma Inheritance Tax Service is and why investors should consider it.
Thanks, Alex. Good to be here. The Puma AIM IHT service invests in AIM-traded companies which qualify for business relief. That means that if investors hold those shares for 2 years and hold them at the date of death, then there is no inheritance tax liable on the value of those shares. Why should investors consider it? There are two common areas where we see investors use the Puma AIM service. Firstly is in ISAs, so they built up properly equity positions in companies over time, free of capital gains tax and free of tax on dividends, but ISAs are liable for inheritance tax. So we have clients who decide to shift their equity exposure out of more conventional assets into AIM assets in order to manage sort of their inheritance tax position. We also have people who use the service for the proceeds of business sales, where they've sold a private family business, but they want to roll over the business relief qualifying aspect, and they can do that by investing in AIM traded shares which qualify for business relief.
And tell us a bit about Puma and its heritage and your own background.
Okay, so Puma's got 3 divisions. They've got a private equity division which runs 2 VCTs and also has EIS schemes that it runs. You've got Puma Property Finance, and they primarily manage an asset-backed business relief solution with a specialist focus on property development lending. And you've got the Puma Public Markets division, which I sit in along with my colleagues Stuart Rollison and Daniel Kane. And we look at listed equities, primarily those on the AIM market, with a focus on the AIM IHT service. We're based in the West End in London. We're a team of over 100 people now. And our parent company is Shore Capital Group, who are a well-known market maker, advisor and broker for UK small and mid-cap listed companies.
And your own role, how long have you been at Puma?
So I've been there 3 years now. I'm investment manager in the Puma Public Markets team. So we're seeing 200 companies a year with a focus on the AIM IHT service thus far.
So tell me, what type of companies are you looking for? Obviously they need to qualify for inheritance tax relief, but what else are you looking for?
Well, we are thinking about it from what are the desired outcomes from an AIM IHT investor. So they're looking for predictable recurring revenues from a growth company. So they've got to have resilient margins, good cash flow. We much favour profitable businesses that have got a proven business model. For us, cash flow is the prime metric that we look for from a valuations point of view.
And what type of companies would you avoid?
So again, going back to that previous point about looking for companies with predictable revenue streams, stable margins, we are a sector generalist, but it does tend to steer us away from biopharma or commodities, where they tend to be early stage concept businesses. They can be loss making, and they definitely have variable revenue lines. So we tend to struggle finding companies that fit our criteria in those sectors, albeit we will still look at those sectors. And
how many companies do you typically hold in the portfolio?
So typically we give a guided range of 30 to 40 companies in the portfolio at any one time. We do run one model. At the moment we've got 34 companies, and our target number is 35, but there can be variation around that with takeovers which may be going on, or just portfolio management over a medium-term view. But 35 is where we guide to as the ideal number.
And AIM is shrinking. Are there enough good opportunities for you to invest in?
Well, I think the good point about that is that the valuations are low. So in the good times, you screen out a lot of companies based on valuation. That certainly was the case back in 2021, 3 years ago, where there were a number of companies that you wouldn't have touched on valuation grounds. I think the majority of companies are now very investable from a valuation standpoint. So it's about trying to find those quality companies that have got our criteria. And so, we do think there are enough. We're not, the 35 companies, we don't feel that we're constrained. We've still got a good watch list of another 8 to a dozen companies above that, which are still on fair valuation. So at the moment, we don't feel constrained, but we do need IPO activity to kick on.
And can you talk to me about some of the recent investments you've made, what those companies do and why you invested?
Probably talk through three. So the first one would be hVivo, and they're based in the UK, but they are a global provider of what's called human challenge trials. So if you're developing a vaccine for a respiratory disease like flu or the common cold, you could go to hVivo to do a phase 1, phase 2 trial using people, and that fast tracks the approval process if it's conducted successfully. And they've just launched a new facility in Canary Wharf, and that's going to allow for treatments of more harmful diseases, so COVID, dengue fever, and so that opens up a lot more opportunities for new tests. And the customers primarily are big pharma or biopharma companies, and cash flow is paid up front and then in instalments, so the cash flow of the business is very strong. Probably another one I'll talk to, a very different kind of business, is one called RedCentric, and they provide managed IT services to over 1,000 both public and private sector customers, and they own and operate their own data centers. What they are seeing is increased growth in data demand for AI within their customer base, and so they've got spare capacity in their data centers, so they can provide both the support required for AI and the greater resource that's required, but also the data management aspect through their data centers. So that's business is very positively positioned. And lastly, Cerillion, which has been an excellent business on the market, they provide a one-size-fits-all software solution that is around payments and billing and customer relationship management tools for the telecoms industry. So if you're a small country with your local telecoms network, maybe an island in the Americas, or a niche player in part of a big territory, they've traditionally used Cerillion's software, but Cerillion are now winning bigger and bigger contracts. They've got in the foothills the small accounts of the big telecoms players like Liberty Media, for example, where they work in one territory. They're proving that the software platform works for them, and then they'll go and displace the very expensive, sometimes dated systems run by Oracle and others that sit within these much larger players. So Cerillion's got a very big market opportunity with one set of software. So it's very margin accretive as they add additional contracts on top.
Okay, and what about some of the older companies you've been invested in for a while?
Yeah, so I'll probably start with one that's been kind of most favourable for our performance over the years is Judges Scientific. Great business, run by David Sickerell and Brad Ormsby. And we've been invested in that since 2016, and they are effectively a buy and build of scientific instrument businesses in the UK. So they'll try and find these very niche businesses. One measures the tensile strength of hair, and it's sold to L'Oreal and others. So when you put your shampoo in your hair, it measures that it doesn't sort of detract from the quality of your hair. Another business of theirs would be Geotech, which measures the cores. When people go and try and extract minerals from the ground, they'll keep a record of the core. So if you want to go back later and try and find a mineral that you're trying to explore or extract, you can go and analyse your cores. So that's another one of their businesses. They've got 25 of these businesses they bought over time, and they're just buying them at 4 to 6 times EBIT, earnings before interest and tax. And so if you're able to recycle your cash flow through high margin scientific instruments businesses and recycle them into more acquisitions, it's just been a very, very successful business model since they launched that in the early 2000s. Another one would be a much more solid, kind of stable, very stable business is Renew Holdings. And that's been held since the inception of the portfolio in July 2014. And they provide critical maintenance services for UK infrastructure assets. So that may be UK rail network, it could be nuclear energy assets, right through to water infrastructure and now digital infrastructure. And it's all about maintenance. It's not about new build programs. It's just maintaining the status quo, annual servicing of these assets, and all of their staff are directly employed. They don't use contractors, so they have a very stable margin profile.
And how often do you sell a stock? And what would make you sell a stock?
So we guide to having around 15% portfolio turnover per year. In terms of what would be a reason for sale, something if a valuation was particularly overextended, we'd look at that. We'll look to see if management are following up on their word. If we have fears about how management are executing, that would be a reason for a sale. But I mean, of course, primarily is have we got the investment case wrong? have the competitive dynamics of the industry changed? And have they lost a key customer? Is a competitor moving in on their territory and they can't react? Those sorts of analysing the competitive environment is probably the most common reason, although we've been quite fortunate and not had many instances of that in recent years. And also we'll just conduct rebalancing just as for portfolio management purposes, just to retain diversification, because that's a key way to manage risk in the portfolio through diversification.
And it's been a very challenging time for AIM. What's that meant for you?
Well, challenging for the companies. Their share prices have derated considerably. I'd say, well, firstly, it's not just AIM. There are other markets which have been impacted by this. It's sort of back-to-back economic shocks of the pandemic, then the Ukraine crisis with interest rates spiking and inflation increasing. So it's been difficult for all markets, but you're right, AIM has suffered just as much as most, if not more than many. In terms of what that means for us and our portfolio, I mean, our portfolio has been fairly resilient. You can see that in the performance. The companies have delivered well during that period, generally speaking. And so they've been able to generate the free cash flow and they've been able to use that for acquisitions, but they also have been able to use it for share buybacks. So that will be very accretive for shareholders over the long term, providing they buy the shares at a reasonable valuation or cheap valuation. The downside is we've seen some takeovers of companies that we would want to keep for the long term. So we've had some companies which have gone into private equity hands, some companies which have chosen to be part of a bigger business. And we really would have liked to be long-term investors in those businesses, but they just felt that the public markets weren't evaluating their business correctly.
So with valuations down, is now a good time to be buying AIM?
I'd say, yeah, no, and generally in a small cap, in a sort of lowering interest rate environment, small cap does very well. So we think, and obviously the budget conversation is ongoing, and so once you pass through those fears, you'd expect AIM to perform more strongly out of that. But we do need flows to come back into UK mid and small cap funds. That's going to be the key catalyst for getting the market going. The outflows from UK equity funds has been pretty precipitous over the last 3 years, and we just need that to turn. Which we think it's a cyclical play, but it's been a very long cycle.
There's quite a lot of investors who are experienced investors, been doing it a long time, but when it comes to AIM, even despite all the inheritance tax benefits, they just won't touch it because they just think it's too risky. What would you say to them?
Well, it is high risk. AIM is a high risk market. Share prices are more volatile than the larger markets. Smaller companies are riskier than larger companies because you can have narrower product sets, you can have customer concentration, and you're relying on a management team who are involved in the day-to-day operations of the business as well. So there's no doubt that the function of small cap, function of a market which is where share prices can move more on a day-to-day basis, it is riskier. But I'd say that's why you choose to use experts in the market, people who follow the companies, people who know the management teams for better or worse, and also to use diversification. You use the ability to have 35 holdings. Don't stay in a portfolio of 15 or 20 because having a larger number of holdings reduces your risk of point failure in the portfolio. So there are ways to manage the risk, but there's no getting away from it being a high-risk market.
And finally, if someone is looking to make a contribution into an inheritance tax service, why should they choose you?
I think we've got all the key elements that people should look for in an AIM IHT service. We've got an experienced team. We've got Stuart Rollison with over 25 years industry experience. Daniel Kane's just joined us. He's got significant small cap experience at Tosca Fund. We've got good performance, which has shown that we do as we say over time. We're a financially stable business in our own right, Puma, and we've got the backing of a very solid balance sheet of Shore Capital. Our service is large enough for people to take comfort in, but not so large that we're constrained from investing in some of the smaller companies on AIM, sort of the 50 to 250 million pound market cap companies, which we can invest in. So we've still got that open universe that our size gives us, but we've also got the comfort, the service being large enough for people not to be concerned about it being too small.
Joe Cornwall of Puma, thank you very much.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.